Cameras on, please. So we're going to finish up liability 752 and then move on to the next topic. Before we get there, I wanted to mention, I know that the course schedule for next year for fall came out, and so for those 2Ls, you might want to know a little bit about the advanced topics and tax course that I'll be teaching in the fall, which is a new course that hadn't been offered before at Georgia. And it's a seminar style course, so it's advanced topics and tax. It'll cover topics that are not covered in sort of the main tax courses, and as well as sort of new topics, hot topics, you know, interesting issues that arise from time to time, and that sort of thing. It'll be a lot different than the tax courses I've taught in the past for a number of reasons. One is it's going to be more discussion format, so it's more styled in the form of a seminar, limited enrollment seminar discussion class. So we'll have more discussion, and also your grade will be partially based on discussion and class participation. The second thing is there won't be a final exam. The grading will be based, in addition to class participation, will be based on writing assignments. And the writing assignments will be likely some kind of practice style memo or other like private letter ruling request. So it'll be based on the topics we've covered, and there'll be some, again, sort of a writing, a practical writing or assignment or 2 or 3. And then also probably supplemented by response papers, where if you read an article, you'll have to write a few page response reaction to it. And so it'll be writing in that way. The other thing that I may offer, and if folks are interested in this, you can let me know, but I may offer, in lieu of the writing, you could instead choose to do a research paper. So that would be a longer sort of research paper that you'd work on as well. So if you chose that option, then your grade would be based on class participation and the longer research paper. So some flexibility, again, more seminar style course. If anybody has any questions about that, you feel free to reach out to me. Okay. Any questions now? All right, well, let's get back to this one. This is page 222 of the partnership tax book, or 225 of the business entity book. We've done most of these problem sets, but we still haven't done 3C. So let me pull that up. So we did all of 1, we did all of 2, we've done 3A and B, and we haven't done 3C here. That's what we're going to do now. So this problem starts out. This problem starts out in the same way. Can you guys see the whiteboard? Okay. In the same way as the other problem. So we've got A and B. They start out, they just contribute. That's book, tax, and outside basis. They each contribute $150 cash. And they buy land 1. Partnership buys land 1 for $300. Then land 1 goes up in value to $800, and C is going to come in. But now C is going to come in by contributing cash, $400 of cash. Remember before we did this problem, C was coming in by contributing $400 of equity in property that C was contributing. But now it's just cash. Same thing happens. We're going to book up A and B's capital accounts to fair market value. So we book up the assets to fair market value. That creates 500 of book gain. That's A and B are 50-50 partners. So they each get 250 of book gain. So that's our book up. And then C is admitted to the partnership. Contributes 400 of cash. So we've got cash up here too. So nothing terribly interesting there. But the next thing the partnership does is it says, okay, well, this land is now worth 800. We can borrow against this land. The bank's going to lend us money against this land. And the bank lends money against the land of 500. So take out a $500,000 loan. You know, let's say that just increases cash by 500. And it's a non-recourse loan and secured by property number one. So bank has said, you know, nobody's personally responsible for this loan. Worst case scenario, the partnership will have to just give up property number one. So the question here is, how is this debt apportioned? Right? We had no debt before, so each partner had a 0 share of partnership liabilities. Afterwards, the partners in the aggregate will have a 500 share of partnership liabilities. But the question is, how is that split among the partners? So again, you'll always start with, is any of this a recourse liability? Is there any economic risk of loss to the partners? And so what you would do then is you would say, okay, the cash is worthless. So we sell the cash for 0. So we have a 900 loss on the cash. We sell number one, not for 0, because it secures a non-recourse loan. We sell it for the amount of non-recourse loan. So we'd have a 500 amount realized, and 800 of book value, so we have a 300 loss on the property number one. So a 900 loss on the cash, a 300 loss on property number one. Remember this economic risk of loss analysis under -2, it's a book value analysis. So we have a 1,200 loss. We'd allocate that 1,200 loss. The partners have agreed to share all the losses, 1/3, 1/3, 1/3. It would drive all their capital accounts down to 0, because our capital accounts are 400 to begin. They each get a 400 loss. Capital account is 0. Even if they have to restore their capital accounts, there is no deficit to restore. So A and B don't have to kick in any money under the partnership agreement. Under state law, A, B, and C don't have to kick in any money to the creditor. And so as we can intuit, no partner bears the economic risk of loss for any portion of this debt. So that means the entire debt is going to be apportioned under 1.72-3, the 3-tier method. So we've got tier 1, we've got tier 2, we've got tier 3, A, B, and C. Tier 1, remember, just this is 1.72-3A. That's where you find our tiers. So tier 1 is going to be the each partner's share partnership minimum gain. Well, we have minimum gain where if we sold the property that secures a non-recourse loan for the amount of non-recourse loan and nothing more, we'd have gain. We sold this property, we have 300 of loss. And remember, partnership minimum gain is another book value concept. Where book and tax differ, you use book value. So we don't have a loss, a gain, we have a loss under that analysis, and so our minimum gain is 0 at this time. And so each partner's share minimum gain is 0. The next tier says, well, what would happen if you sold the property that secures a non-recourse loan for the amount of non-recourse loan? How much gain would be allocated to the partners under 704C? So we would say, okay, and I'm going to put this in red because it's not really happening. But if it did happen, we would have a book loss of 300. Amount realized 500, book value 800. We would have a tax gain of 200. We would allocate the book loss 1/3 each. We would give the non-contributing partner C. Remember, this is reverse 704C. So A and B are the contributing partners with respect to property number 1. They got the book up, so they're on the hook for the 704C gain. So A and B are the contributing partners. C is the non-contributing partner. We can't give him a tax loss because of the ceiling rule. We don't have any tax loss to give, so we give him 0. Whatever's left goes to the contributing partner. Here we have 2 contributing partners. It's pretty easy. They're 50-50 vis-a-vis each other. So the tax gain would be split 50-50 among the contributing partners. And if we're using the traditional method, we would just stop there. If we were using the remedial method, we would add remedials. We would offset the impact of the ceiling rule by creating a loss and give it to C, the non-contributing partner, to match up book and tax. We have an offsetting 100 that we give to the contributing partner, here partners, so each would get 50. So the answer to the question, how much 704C gain will be allocated to the partners, depends. Are we using a remedial method or a traditional method? If we use a traditional method, A and B each get 100 under tier 2. If we used remedial method, A and B would each get 150 under tier 2. So that's an important fact we'd have to know. Let's just assume for now that the traditional method is used. So what that means, now we're back to real world. That was all hypothetical. So get rid of this. What all that analysis means that A gets 100 under tier 2, and B gets 100 under tier 2, and C doesn't get allocated any gain. Okay, any questions about why A and B each get 100 to them under tier 2? And we could sum this here. We could have a total section. So we know we have 500 total that we got to get to. So tier 3 is whatever's left. So we have 300 left. And again, normally in an exam situation, I would just tell you how it specifies, how tier 3 is specified, the excess non-recourse liability. And here it's pretty straightforward that you would specify it 1/3, 1/3, 1/3. I mean, they're a 1/3, 1/3, 1/3 partnership. There is some flexibility to do it some other way, but we don't have to get into that kind of complexity. So if the tier 3 is 1/3, 1/3, 1/3, then A gets another 100, B gets another 100, and C gets 100. And so the total for A is 200, the total for B is 200, the total for C is 100. So that's the partner's share of the partnership liabilities. And it goes up from 0 to these numbers for each partner. So under 752A and 722, 752A creates a deemed contribution of money in these amounts. 722A says when you contribute money, your outside basis goes up by the amount of money. So A's outside basis goes up by 200. B's outside basis goes up by 200. C's outside basis goes up by 100. So once we're done with all these transactions, again, I might ask you, what are the consequences of these transactions? There's really no tax consequences yet. But I would also ask you, what's the partnership balance sheet look like after these transactions? And then you would just sum these up. Again, we could do some checking, make sure our numbers aren't screwed up. Our left side of our balance sheet has 1,700 of book value, and our right side of the balance sheet has 500 plus 400 plus 400 plus 400. That's 1,700. So our balance sheet balance, our left side of the balance sheet equals our right side of the balance sheet from a book perspective. We could also look at our inside basis is 1,200, and our outside basis is also 1,200. That's typically, but not always, the case that those things will balance. So I've said this before, that if your inside basis and outside basis don't balance, that doesn't necessarily mean you've done something wrong. Whereas if the book value of your assets don't equal your debt plus your capital accounts, your book capital accounts, then you've definitely done something wrong. So your book balance sheet must balance. Your tax balance sheet, if you will, doesn't necessarily have to balance. We'll see some more of that as we go through the course. But here it does. And again, that's typically the case. So that's the answer. A shares 200, B shares 200, C shares 100. That's really the meat of the problem. Okay, I'll stop there and take questions on problem 3C. If this had been remedial, by the way, if we had used remedial, then A and B would each get 150 up here. And then we'd only have 200 left in tier 3, and 200 would be divided 3 ways. It would be 67, 67, 67. So that would mean that A's share of the liability would now go up from 0 to 217, and B's to 217, and C's to 67. So no immediate consequences, but just change the outside basis. Any questions? I've previously explained, this 3-tier, that it's an instrumental approach that we're trying to give people, the basis so they can use non-recourse deductions in tier 1. In tier 2, we're trying to protect contributors from recognizing counterintuitive gain when they contribute property subject to a debt. And tier 3 is kind of like we got to do something with tier 3. There's no good, as far as I can tell, explanation for why this is the right answer, because we're not dealing with contribution of property subject to a debt, but this is just the way it's done. So it's hard to intellectualize these results. This is just the rule. So. Okay, I'm not hearing any questions or seeing any questions. We'll move on. So this is problem 4. I don't want to belabor this. This is not nearly as important as what we've just done. So again, let's look at problems 1 and 2 and 3 are really the meat of this assignment here. But if we have A, B, and C, they're equal owners of an LLC. In an LLC, no partners are liable for the partnership debts unless they agree to be liable. So if the LLC incurs a $1 million recourse loan, and that's recourse under state law, which means that the lender is not limiting itself explicitly to one or more properties of the partnership. But because if we don't have any guarantees, because from an economic perspective, the lender is limiting itself to one or more assets of the partnership. An LLC recourse loan like this would end up being a non-recourse liability under these -2-3 rules, because it's basically like a floating lien over all of the LLC's assets. That's the only thing the lender can look to. Only partnership property. Now, multiple partnership properties potentially. So this would end up being a non-recourse loan under 752-3, and we'd use those rules, but for the guarantee. The guarantee is what makes it different. So if we just stopped here, if we just stopped after this sentence, this would be a non-recourse loan under 752-3. Stopped after this sentence. Then if we stop after this sentence, A and B say, you know what, and oftentimes in a closely held LLC context, the lender is going to require partners to guarantee the debt. So if A and B each guarantee the debt, they jointly and severally guarantee the debt, then now it becomes a recourse loan because A and B bear the economic risk of loss. The lender has not limited itself to one or more assets of the partnership. Now the lender could go after A and B's assets. And so in that case, A and B would each bear the economic risk of loss to the tune of $500,000. Okay, everybody got that? Now we'll add the last sentence. Well, now C comes in and says, okay, well, you know what, A and B, I will indemnify you. So, it's just, this is what legal agreements do. They allocate risk. So they're allocating risk, and C says, okay, you know what, I will be on the hook. If you're called to indemnify, you're called to pay the guarantee, I will then reimburse you, but only to the extent of $200,000. I'll get the first $200,000, and then you get the rest, the remaining $800,000. And under the old rules, before these bottom dollar guarantee regulations that I'll talk about in a second, again, it would still be a recourse loan. C gets the first $200,000 when the world comes to an end, the atom bomb, and everything's sold for zero, and everybody sues everybody. C is going to pay the first $200,000 that is owed to the lender, and then A and B are going to split the remaining $800,000. And that would be where the debt goes. Folks at the IRS and Treasury got worried that people were using these, well, one thing to look at here is that A and B, as an economic matter, as a practical matter, they only are burdened to the extent the property in the LLC goes below, loses more than 200,000. Or the other way to say it, they only are harmed once the lender loses more than 200,000. So you think about like C as sort of a top dollar guarantee. C suffers the first 200,000. A and B then step in on sort of the bottom dollars. And the idea that, well, if it's a bottom dollar guarantee, the risk of actually being called to pay it is reduced. And maybe these bottom dollar guarantees are not really economic. And so we should treat them more skeptically. And so the regs do that. These new bottom dollar guarantee regs say, if you have a bottom dollar guarantee, which is what A and B have, then we're going to apportion that, not under the recourse rules, but under the non-recourse rules. So in A, what the answer would be is that C gets the first 200,000 of the debt under the recourse rules. So C is deemed to have an economic risk of loss of 200. So C gets the first 200. the remaining 800 would be divided under the non-recourse rules. And again, in the absence of minimum, there's no minimum gain and minimum 704C gain, you go to tier 3 and divide it 3 ways. So 800 divided by 3 is 267. So C would get 200 off the top and then 267, and A and B would each get 267, and that's the way it would go. Instead of the under the old rules, it would be 200 to C and 400 each to A and B. That's the bottom dollar guarantee rules in effect. I don't think they make a whole lot of sense, but that's where we are. B just gets to that there's a sort of de minimis rule that says if your bottom dollar only to the extent of if your bottom dollar guarantee is 90% of what it would be without it, then you ignore these rules. You ignore this special rule that treats bottom dollar guarantees as a non-recourse debt. So that would mean here A and B are each have a bottom dollar guarantee of 450 out of 500 total, so they satisfy this 10% de minimis rule. So in B, the normal rules would apply, which would mean C gets 100 because that's the indemnification cap, and then A and B would split the remaining 450. So, like I said, don't worry about problem 4. I will not test you on bottom dollar guarantees, but you should know that the issue is out there when you get in these situations where folks are slicing the debt in this sort of vertical way. If A and B, if we just stop here again, we don't have any bottom dollar guarantee. If we stop after A and B agree to just split 50% of the debt, that's not bottom dollar because they're splitting the debt sort of horizontally. They each bear 50 cents of every dollar that the lender bears. It's when C comes in and takes the top off that A and B become bottom dollar. All right, any questions on 4? Or any of this stuff under 1052 before we move on? Okay, the next topic, let's turn to the code. The next topic we're going to deal with, and this is a nice break. It's kind of like the easiest stuff we'll do in this class is going to be today. And it's a common fact pattern, and it will be on the exam. I usually like to give a problem like this on the first problem of the exam. It's kind of easy. Again, it's practical, comes up a lot. It's relatively easy compared to the stuff we do. So it's a nice way to break into the exam, get people feeling good about things. And it's just a sale of a partnership interest. So a partner is going to be selling, in our class, usually his or her entire partnership interest to a new partner. And it's called a sale across. So the acquisition, we've done an acquisition where you contribute cash or property to the partnership and get a partnership interest from the partnership. So that would not be a sale across, that's a contribution. A sale across is when you're not giving cash or property, or you're not getting cash or property. Well, you're not giving, if you're the buyer, you're not giving cash or property to the partnership, you're giving cash or property to another partner. Sale across. So the rules here, the statutory rules, let's turn to section 741 of the code. Start there. 741 of the code. Section 741 of the code says, in the case of a sale or exchange of an interest in a partnership, so again, that's our sale across, gain or loss shall be recognized to the transferor or partner. So again, we're just using our traditional 1001 rules. We have our amount realized. We put that over our adjusted basis, our outside basis. That's going to result in gain or loss realized. and that gain or loss is recognized. That's what this sentence says. And then it says that except as otherwise provided in section 751, which is a big exception, but the default rule is capital gain or loss. Sale or exchange of a capital asset, we know from tax 1, when you have gain or loss from the sale or exchange of a capital asset, that's a capital gain, capital loss. Long-term, short-term, depending on how long you've held the partnership interest before you sold. Long-term if more than a year, short-term if less than a year. So that's pretty straightforward and probably what you would intuit, perhaps, if you had to guess. Now let's turn to section 752D. 752D, our good friend 752. We focus a lot on 752A and 752B, our deemed contributions, deemed distributions. 752D is important. It's just not very clear what it says. You might have a tough time getting there from this language, but it's important. And it applies when we have a sale or exchange of a partnership interest. Then it says liabilities shall be treated in the same manner as liabilities in connection with a sale or exchange of property not associated with partnerships. And all that means is that when you sell your partnership interest, your share of the liabilities is included in the amount realized. You're effectively shedding those liabilities. They're coming off your books. And so we include them in the amount realized. And that makes sense. We've included them in your outside basis already by virtue of 752A. So you have to include them in the amount realized as well. Otherwise, we're going to miscalculate your gain or loss. So if it goes in the outside basis, it's got to also go in the amount realized. We'll see how that works. But let's not forget that. That's a common error students will make. Will be to forget to include the selling partner's share of partnership liabilities in the amount realized. So this is one of those, like, I often tell you, struggle with the language, fight with it. Here you just rewrite it because it just doesn't say what it should say. And it should say that the partner's share of liabilities is included in the amount realized. So I give you permission to rewrite that in your own language because it's so vague. Okay, any questions on that? All right, and then we get to the meat of the matter here, which is 751, right? That's the exception for it being capital gain. We're going to spend some time working through this, but it carves out, basically says, well, it's not going to be capital gain to the extent that you receive value for the unrealized receivables of the partnership or inventory items of the partnership. And these are known as hot assets. And these are sort of classic ordinary assets. And we'll work through 751 in more detail when we get to the problems. Okay, so those are the consequences of the seller. Again, where 751A is going to be the real analytical part. What about the buyer? What about the buyer? What are the buyer's consequences? Well, they're governed by 742. Let's turn to section 742 of the code. 742 says the basis of an interest in a partnership acquired other than by contribution. Well, we know what their outside basis is by contribution. 722 tells us it's a carryover basis from whatever property we contributed. But if we acquire other than by contribution, that's going to be determined under our ordinary rules section. So it's going to be a cost basis under section 1012. If we get it from a decedent, so we inherit it from a decedent, then we'll get a fair market value on death basis under section 1014. If we get it as a gift, it'll be a carryover basis under section 1015. But we're covering here purchases. So if it's just a purchase, it's going to be a section 1012 cost basis, whatever we pay for it. So that's sort of our initial basis in the partnership interest when we buy it. Now, also when we buy it under 752A, now we become a partner. We may very well now receive a share of the partnership debt. So again, we'll have to run through that 752A analysis, and we may now have a deemed contribution as well, because now we're becoming a partner. We have no share of partnership debt before we buy the partnership interest. We may very well, under 752 rules, now have a share of the partnership liabilities, and again, we have to sort of run that to ground. If we step into the selling partner's shoes with respect to the debt, again, if it's like a general partner and we're now a general partner and we're jointly and severally liable the same way the selling partner was, whatever came off the selling partner's books will now go into our books. And we'll see how this works in the context of a problem. But again, that's another sort of common error that students might make is not appreciating that the buying partner may now get a share of the partnership debt that would cause that partner's outside basis to be increased by the share of that debt. So the outside basis of the partner is going to be determined by reference to the amount he or she pays. One issue is going to be, well, what about the inside basis? Does the inside basis change? Does the partnership's basis in its own assets change? If you think about it, if your outside basis is determined by what you pay for it, but your inside basis doesn't change, we could get that inside basis, outside basis disparity that I was talking about. Right? Think about a highly appreciated partnership. It might have very low basis relative to value. Someone then pays fair market value for a portion of that. Their outside basis is going to be very high. The inside basis would still stay low if you didn't change the inside basis. And the default rule under 743A, and this is what we're going to spend a lot of time on Wednesday, the default rule is that the basis, inside basis shall not be adjusted. And that's one situation where we'll have that inside basis, outside basis disparity. But then we have an exception to the general rule under 743B that we'll cover next class. The last thing we would think about here would be, well, what about the buying partner's capital account? What's the buying partner's capital account? And we're going to determine that under the capital account maintenance rules. Remember, those are found in 1.704-1B2 4 little i's. You don't have to turn there because I'll just show it to you, but it's a simple rule. This is -1B2 4 little i's L. -1B2 4 little i's L. And it has a simple rule that the capital accounts of the partners will not be considered to be maintained in accordance with these rules. Remember, we need to be maintained in accordance with these rules to get the advantage of the substantial economic effect safe harbor. Unless upon the transfer of all or part of the interest in the partnership, the capital account of the transferor that's attributable to the transfer interest carries over. The transferee partner, it steps into the shoes. The transferee partner steps into the shoes of the transferor's capital account. Just carries straight over. So the transferee partner inherits the transferor's capital account. Okay, So those are the basic rules for the seller and the buyer. Again, we're going to focus now on the seller consequences. And so let's use the problems. This is on page 320 here. And we've got a simple fact pattern, A, B, and C. They had contributed cash of $75,000 to the partnership. They used 75 to buy inventory. They used 75 to buy inventory here. We can't do that, so let's see. That didn't work. 75 to buy the inventory. They used 105 to buy the capital asset. They have 45 left. They generate an account receivable from services. And this is a cash method partnership. So when you have a cash method partnership, you don't recognize income when you perform services until you receive payment. So you have a receivable that has value, but it has no basis because you haven't ever had any paid any tax. So the inventory then goes up in value by 15. The capital asset goes up in value by 120. And the receivable, of course, has value of 45, even though there's no basis. So, and again, if you wanted to create your capital accounts, it would all just be 75,000 for each of A, B, and C. So we then have this hypothetical. Now A is going to, and no debt in this partnership. So we start off very simply, there's no debt. So A is going to sell his interest for 135 to D. D buys A's interest for 135. So it's a sale across of the partnership. So we go here. It's really simple to start. And we say, okay, A sells his interest. So as amount realized is 135, the cash that he receives. And if you want your definition of amount realized, it's in 1001B. And again, let's check under 72D, we would also include in the amount realized A's share of the partnership liabilities. But again, the partnership has no liabilities, so A's share is 0. Then we put that over A's outside basis, which is 75. And so we have 60 of gain. That gain is realized and recognized. And the question now is going to be, what's the character of that gain? What's the character of that gain? And the first thing we got to deal with, well, now this is where 751 comes into play. So we go to 751. A. And the first thing we can do is determine whether the partnership has any hot assets. So if the partnership has no hot assets, then it's all just capital gain or capital loss. So what are the hot assets? It's unrealized receivables and it's inventory items. What does this mean? What do these things mean? They're terms of art. So we go down to the definition of unrealized receivables. And it says in 751C, the term unrealized receivables includes, to the extent not previously included in income under the method of accounting used by the partnership, any rights to payment for goods delivered or services rendered. These are your cash method accounts receivables. So that account receivable for services rendered, that 0 basis account receivable, that's an unrealized receivable. So our account receivable is an unrealized receivable. That's a classic unrealized receivable. The account receivable, a cash method partnership. Also, just to note, again, I'm not going to get into these details, but to the extent you have built-in depreciation recapture under 1245, that's also treated as unrealized receivable to the extent of the recapture, built-in recapture gain. And just if you're stepping back here, what the code is trying to do is trying to prevent the seller from converting what would be ordinary income if the partnership sold its assets into capital gain by selling the partnership interest. So here, the account receivable is an unrealized receivable. But what's an inventory item? That's 751D. Property of the partnership of the kind described in 1221A1. Those are our inventory-like assets, property held for sale to customers in the ordinary course of a trade or business. And then any other property which is not a capital asset nor a 1231 asset, basically an ordinary asset. And so that includes inventory. I mean, our classic inventory item is inventory, which we have here. So we have two hot assets. Two hot assets. Inventory and our receivables are the hot assets. So once we have at least one, now we have to do a 751A analysis. And the code itself is not particularly illuminating as to how you would do this. It talks about your share attributable to. So what does that mean? That's kind of vague, what attributable to means. So this is where the regs come in. And so let's turn to 1.71-1. So just a word of caution here. So the code has been amended. It used to be that you had to have inventory items which have substantially appreciated in value were a hot asset in this context. Now it's been changed as inventory items. They don't have to have substantially appreciated in value. So where the code and the reg are inconsistent, the code wins. And this sometimes happens, that the IRS and Treasury don't update everything in real time. But what this reg still tells you is how you determine, how you apply 751. So, and it's in -1 A2. The income or loss realized by a partner upon the sale or exchange of his interest is the amount of income or loss from 751 property from hot assets that would have been allocated to the partner if the partnership had sold its property in a fully taxable transaction. So again, we hypothesize a transaction. We say, okay, what if the partnership sold all of its hot assets for fair market value immediately before the sale? How much gain would be allocated to the selling partner? Whatever that amount is ordinary income. So if we sold the inventory for 90, we'd have 15 of gain on the inventory. we sold the receivable for 45, we'd have 45 of gain on the receivable. So we'd have 60 of gain. This is a really simple fact pattern, A, B, and C. There's no 704C issue here, so it makes it easy. And they share everything 1/3, 1/3, 1/3. So A would have been allocated 20 of the gain on the inventory of the receivables. So 20 of this gain is ordinary income. Under 751A. And then residual, whatever's left, is characterized under the default rule 741, capital. And here they held the partnership in for more than a year, it would be long-term capital gain. So the answer here is 20 of ordinary income, 40 of long-term capital gain. And again, the method here, what's key is you always start determining the overall gain or loss. This is what we just did. And then you apply 751, and then whatever's left is 741. Okay, any questions on 1A? Okay, we changed this 1B. And what we do here is now the partners contributed a lot more cash. So they have more outside basis. And they use the extra cash to buy the capital asset, which now has gone down in value. The capital asset has a built-in loss instead of a built-in gain. D is still paying 135 because the value is the same. So how do we apply this? Again, we start off and you say, okay, what's the amount realized? The amount realized is still 135. Now the outside basis is 150. Because remember, they contributed 150 of cash in. So now is a 15 of overall loss realized and recognized. We still have to apply 751 because we have hot assets, and the hot asset gain is unchanged. It's still 20 of ordinary income. And the only thing that makes this a little bit harder is that, again, we have to make it fit. So now the difference between the 15 overall loss and the 20 of ordinary income is he's going to have a 35 of long-term capital loss. This is under 751A. This is under 741. So again, whenever we add these two together, it's got to sum to that amount. And it can be opposite values, whatever, opposite, positive, negative, such. And this makes sense because A's share of the capital loss is 35. The capital asset has a built-in loss of 105. He's a 1/3 partner. So this gets it right. Okay. Any questions on that? All right, back to the problem here. Now, each partner contributed 45 of cash, and then they still bought these assets. They still had 225 of total cash. So where'd they get that difference? Well, they got that extra 90 by borrowing it. So they borrowed 90,000, and A, B, and C share of that debt is 1/3 each. Could be a non-recourse debt, could be a recourse debt. Again, if they're sharing everything 1/3, it's going to be 1/3 each. So, and now when D buys his interest, D's not going to pay 75 for it because now the partnership has 90 of debt. So the equity of the partnership is 405 less 90, which is 315. So he's only going to pay 1/3 of 315. He's going to pay 105. So how does that work? And this is where 752D comes into play. So you go to 752. Well, what's going to happen here is our amount realized is A's amount realized. A's amount realized is the 105 of cash contributed plus A's 30 share of partnership liabilities. A's outside basis is the 45 of cash contributed at the outset plus A's share of the liabilities. So we have the 60 of gain, and it's the same answer as an A. The same answer as an A, and it's just we have to do this step here. And that's what 752D tells us. When you sell your partnership interest, your share of the partnership debt gets included in your amount realized. You'll take the cash, the property you receive from the buyer, you will add your share of the partnership debt. And again, it makes sense because we've included in your outside basis as well. If we screwed this up, if we forgot to do that, we'd end up with only 30 of gain. But remember, A starts out with 45 of cash. A walks away with 105 of cash. So A needs to have 60 of gain. And that's what 72D ensures. Okay? So the answer to C is the same as A. There's just this one little step that is required to put the share of the debt in the amount realized, as well as the outside basis. Okay, questions on C? Okay, and then D is not as important. So in D, we have a mid-year transfer. We won't deal with mid-year transfers. So, but the issue here is that in that one quarter of the year, A would get allocated income from that one quarter. And there are different ways that that's done, but one way is we can close the books. And if the partnership earned 90,000 of income in the first quarter, A's share of that is 30. So A would have been allocated 30 of income. That would go on A's tax return. And that would also increase A's outside basis by 30. And then the buying partner, because there's that 30 of extra value attributable to A's interest, let's say there's 90 of cash that was earned. A's share of the earned cash was 30. So now the buyer would pay 165 because he's buying, on the balance sheet now would have another 90 of assets. So we'd show, again, we could have more cash. We have 135 of cash because they've earned that 90 of cash, which was income, and now it's cash. So the buyer will pay 165, and so what's going to end up happening is that A's amount realized, this is, again, no debt is here in this partnership. A's gets a 165 amount realized. A's outside basis at the beginning of the year was 75, but when A gets allocated that share of income, A's outside basis goes up by 30. That's section 705. Remember, you get allocated income, your share, your income allocation increases your outside basis. That's 705. A1. So again, A is going to have that 60 of gain. And so it's the same 20-40 split as before. You end up in the same answer as before, at least on the sale. A also has 30 of income flow through for the first quarter of the year. But don't sweat that. Let's make sure we really understand A, B, and C. Okay, because I'll have a sale will occur on January 1. And then you won't have to worry about splitting the year up like this. January 1 or December 31. All right. Questions on that? All right, 2, we move to 2. So in 2, we now have the same facts, except now we'll put the partnership on the accrual method. So now the accrual method is going to make the basis of the receivables 45. So there's no built-in appreciation of the receivable. We only have one hot asset, the inventory. And technically, the account method receivable, accrual method account receivable is a hot asset because it's an inventory item. If you go into 1221 accounts receivables, whether a cash method or accrual are ordinary. And so it would now be an inventory item, but because there's no built-in gain or loss, we can just ignore it. So we're just focused now on the inventory is the only hot asset that has a gain or loss. And here, A sells his interest to D on January 1. So again, very simple. So now D is going to pay 135. And there's no debt in this partnership. So now the outside basis is 90. The 75 of cash contributed, then the 45 of income on the receivable creation, 15 of which was allocated to A. So A's outside basis is now 90, 75 of cash contributed plus the 15 of gain previously allocated to A. So now we have 45 of overall gain. Our only hot asset is the inventory. If we sold that for fair market value, there'd be 15 of gain, 5 of which is allocated to A. So A has 5 of ordinary income. Whatever's left is capital gain. So that's pretty straightforward. Moving on. So this is kind of a weird rule. Now the inventory, remember, we characterize assets at the partnership level. So we're asking, why does the partnership hold the property? Is it property held for sale to customers by the partnership? We don't really care what the partner does. And so if the inventory, if the item, which we were calling inventory, is held by the partnership as a capital asset. So again, let's say A is a dealer in real estate. A sells real estate individually as his or her business, engages in lots of real estate sales. But the partnership holds an item of real estate for investment, speculative investment. Their partnership isn't selling everything quickly and such. So generally that inventory would not be a hot asset because it's not an inventory item. But 751D3 is an exception So the rule really, and it says, in addition to, it also defines hot assets. To encompass this somewhat unusual fact pattern. (71D3) includes inventory item, any other property held by the partnership. So it's not inventory, not an ordinary asset held by the partnership, but if it had been held by the selling partner, would be considered property that's inventory or other ordinary. And so here in B, it's the same answer as in A. 71D3, though, is the mechanism by which, and it's designed to avoid the sort of game playing that could be played where a dealer tries to hold certain assets through a partnership to convert ordinary income into capital gain. So B is not that important either. So A is important, B is not that important. In C, there's another issue with tiered partnerships. So in C, what if instead of holding the inventory, we have a structure like this? We've got A, B, and C, each own the partnership, which then owns a 50% interest in another partnership, 50% owned by others, and that partnership owns inventory with a fair market value of 180 and adjusted basis of 150. And what 751F does is it tells you in that circumstance you have to look through the tiers and treat this partnership as owning 50% of all of the items down below. So you end up with the same answer as an A, because this partnership, this ABC partnership, is considered to own half the inventory with a fair market value of 90 and adjusted basis 75. So same answer as an A, and 751F does the work there to look through. And that's kind of intuitive, because otherwise you could avoid this rule by using tiered partnerships to hold your hot assets. So that's not going to work as an avoidance strategy. Any questions on that? Again, not that important. I'm not going to test you on tiered partnerships, but you should know it's out there. And you can imagine if complicated arrangements is 704C and all that, when you get into tiers, it can get complicated really quickly. But lucky for us, we won't have to deal with those complications. And then finally, in addition to this balance sheet, they also have this favorable contract that's worth, it's a sort of in the money contract. It's a good deal. They're going to get paid to perform real estate services in the future. And because it's such a good contract, it's actually worth something. It has a present value that the expected value is greater than the expected cost. And so it's in the money. And so now there's another asset that's worth 30,000. It doesn't, we haven't paid any tax on that value. And so, but now the buyer is going to pay an extra 1/3 of 30,000, $10,000 to A because of this favorable contract. And so we go into this analysis again. And so now the amount realized now is going to be 145 because the partnership has the existing assets, now has this other asset worth 30, and A's share of that is 1/3. So his amount realized is 145. His outside basis is still 90. So now we have 55 of gain overall. And in terms of our hot assets, we have our inventory, And now the question is, what about this contract? This is the Ledoux case. I didn't ask you to read it very carefully, but Ledoux dealt with a situation where you have a favorable contract to perform services, that you would generate ordinary income when you perform these services. It's not quite an account receivable. An account receivable is where you've already performed the services and you're just awaiting payment. And so the question in Ledoux is whether this favorable contract to perform services is itself a hot asset, is an unrealized receivable, even though it's not what tax lawyers would think of as an unrealized receivable. And the Ledoux court just read the text and said, yeah, it is. This type of favorable management contract is an unrealized receivable. And so if we sold it for fair market value, it would be 30, 10 of which would go to A. So again, now A's hot asset gain is 15. 5 from the inventory, 10 from the contract. So Ledoux says yes. And then whatever's left is our long-term capital gain. So this is 71A, 741. And so the extra 10, again, comes from the contract, and Ledoux is what does the work to say that that's a hot asset. What makes this counterintuitive is that if the partnership did sell the asset, that would be capital gain. That's just goodwill. They're showing goodwill. The contract is a capital asset in the partnership's hands. And so it's this weird circumstance where if the partnership sold the asset, there would be capital gain. But if the partnership continues to hold the asset and earn income from the asset, the income would be ordinary income. And that's true in a lot of cases. If you own a building, you sell the building for a gain, it's going to be capital gain or 1231 gain. But if you hold the building, you're going to get rents, it's going to be ordinary income. So conceptually, this Ledoux case doesn't really hold water. Again, they didn't look at it conceptually as much as just read what Congress wrote, and what Congress wrote arguably is expansive enough to cover this, and that's what they found. So you just have to know the law, know that Ledoux will capture this contract to perform services in the future. And if it has present value, the key is it has to be in the money. If it's a fair contract, so a contract on day one is not going to be in the money because it's going to be, the expected value is going to equal the expected cost, but it can grow into the money. So if you have a contract for services and you're getting paid X dollars per year, and then next year, if you were to negotiate the contract this year, you would get less than X because the market has changed, then that contract is favorable and has current value. That's what apparently happened here. It's like interest rates. If you have a loan and you're paying an interest rate and the interest rates rise, now your debt instrument is favorable because you're paying lower than market interest rates. Here, presumably because the management contract has value, that the management compensation rate is higher than current market value. But anyway, again, that's conceptually, you don't have to worry as much as just know what Ledoux says. All right, any questions on that? All right, so next class, we're going to flip it around and talk about the buyer's consequence. This is pretty easy, pretty straightforward. The buyer's stuff is a little bit harder, but again, not so bad relative to what we've done all year. All right, folks have any questions or comments, feel free to reach out. Otherwise, I'll see everybody on Wednesday. Bye-bye.